Welcome back to the Money List. In this video, I'm going to show you how to place a call or put option. And you should care about this because for every 1% that you make sitting on a share of stock, you will make 2% in an option. So you will basically double your money with an option. And with options, you can bet on the stock going up, which is a call, or you can bet on the stock going down, which is a put. And that's what this channel is all about. It is about identifying calls and puts and doubling or tripling my money. And it took me 20 years to figure out how to place that first order. I read dozens of books, I watched dozens of YouTube videos, and none of them will show you what this video will show you. And after this video, you will understand how to place the order, how much money it will take to place the order, and how much money you may lose on that order. And once you understand this, you will be able to develop your own trading strategy. And as you're watching the video, as soon as you don't understand something, pause the video, ask AI, and it'll give you a full breakdown of it. And then continue watching the video, and you may have to watch a part of the video 1 or 2 times. But I assure you that after a few trades, you're gonna understand, and after 10 trades, you'll really understand. And because an option contract can expire worthless, which means you lose all your money, you should probably start with $100 or $200 until you understand how it works. That way you're risking a little to learn how it works. And in case you want to refer to this video in the future, it will have its own playlist. So click under playlists on the channel and you will find this video if you want to refer to it again. And before I get started, remember that this video and nothing on this channel is financial advice. Please do your own homework and your own research before you start investing. Okay, so enough prep talk, let's get started. First thing you're gonna do is find the stock that you want to invest in and then go to the options chain. Each platform is different, so I don't know how it works with your platform, but every platform must have an options chain button. So for this video, I'm gonna show you on E-Trade. Let's go. Okay, so for this video, I'm gonna show you 3 different examples of 3 different prices of stock that range from low, medium to high. In this case, we're choosing Fubo TV, which is priced at $3.64. And by the way, I'm going to place a call option on Fubo in the coming days. So the first thing you're gonna wanna do is go to the options tab on your platform, which is right here on E-Trade. We click on that, and then we see a list of dates here and a bunch of prices here. The first thing you're going to want to do is pull up about 11 strike prices, or sometimes you may want to pull up all of them, but for this video we'll pull up 11. So it shows us 11 strike prices, and this is the strike price here, which is in the middle. And on the right we have puts, which is betting that the stock will go down, and on the left we have calls, which is betting that the stock will go up. So now that we have identified the options chain button, let's talk about what a strike price is. Now you can use ChatGPT and get the fancy definition of a strike price, but I'm gonna say it in trading street terms. A strike price is where you think the stock is going, whether it's up or whether it's down. And if the stock hits that strike price, your option is now, quote, in the money. And I will show you what it looks like when it's in the money because it will have a blue bar across it. So if your stock is in the money, that means it hit the strike price and it's either over or under it, depending on if you have a call or a put. You are now liable for 100 shares of that stock. So right off the bat, I'm going to tell you, I've never been liable for 100 shares because I don't want to own 100 shares. I don't even have enough money in my account to own 100 shares. So I'm going to show you what that looks like in a minute. But what I'm basically trying to say is you're going to want to get rid of the option contract on the expiration date. if it's in the money, because you will be liable for those 100 shares. And eventually, when you learn how this works, you may want to keep the 100 shares. With that said, let's continue and I'll explain more in the video. The first thing we're going to want to do is decide on a date to choose. So in this case, our choices are October 24th, November 7th, so on and so on, and it goes all the way until January 21st, 2028. So we see that there's a lot of dates to choose over the course of 2 years. And I'm not going to explain the advantages and disadvantages of the dates at this time in this video. My upcoming videos will explain it as I choose the trades. So for this video, when I place a Fubo call option, it will be May 15th, 2026. So we click on that date and we see the 11 strike prices here. So being that Fubo TV is trading at $3.64, and I think it's going higher by May 15th, I would either choose a $4 strike, a $4.50 strike, a $5, $5.50, or $6 strike. So let's say I choose the $4 strike. The price of that one contract, is between 98 cents and 86 cents, because 86 cents was the last price that someone paid for it. But the asking price, which is here, is 98 cents. So you will probably have to pay the asking price. You could put a bid for 82 cents, but the order may not fill. So I usually just put the asking price because I want to get it right away. But if you want to be cheap and you want to be picky, you could put the bid price. But we see that the last price was 86 cents, so I doubt you're going to get the bid price. You're going to get somewhere between 86 cents and 98 cents. So let's click on the $4 strike price and let's place the order. Okay, so this screen now pops up and this is what you do. You are placing a call or you're placing a put. Call is betting that the stock will go up. Put is betting that the stock will go down. These are the two things that I'm going to show you in this video. I will not show you all of this other stuff because you do not need to know that in the beginning. This other stuff is very confusing. I don't even know how to do all of this stuff. The only other two I know how to do is a straddle and a strangle. So don't worry about all of this other stuff. So our strategy is a call, which you see here, call. Our action is buy open. So did everybody get that? It's buy open to open an order, sell close to close the order and cash out. And if you just let the contract expire worthless, it'll come up as a negative number on your account. That's if there's no profits in the contract. But if there is profits, obviously you're going to sell to close. And our price type will be limit. You always want to choose limit because you don't want to get stuck with a higher price. Market price will give you whatever the computer wants to give you. I've never chosen market price and I never will. I always do limit. And then you can choose the duration, which is good for the day, good for 60 days, and I don't know what these other three are. And I've never chosen good for 60 days because I'm not going to sit there and wait 60 days. Either it fills for that day and I get it that day, or I wait till the next day. So I've only done good for day. And if it doesn't fill that day, it expires and then I try again the next day. So I choose good for day. Then my limit price, because I chose limit, will be the asking price. So the asking price, I would enter 0.98. So we see that one quantity, which is one call option contract, is $100, or it's $98.52. That one contract is worth 100 shares of Fubo. So on expiration date, which would be May 15th, 2026, if this call option contract is over $4, which is the strike, I better have enough money in my account to cover 100 shares of Fubo. If I don't, my account will be flagged. And like I said earlier in the video, I don't want to have 100 shares of Fubo. I want to get rid of the contract, either before expiration date or on expiration date. So when I click preview order, it takes me to this page. And keep in mind that we entered a limit price of 98 cents. Sometimes the platform will make you choose either 95 cents or $1 because they want to keep it in increments of 5 cents. Now, I'm not sure why they do this. It doesn't mean that they do it for every price. Like this time, it gave us 98 cents. But I thought it would make us choose $1 or 95 cents. So you will probably encounter that as you trade. And we see that the volume here is 211. I'll talk more about that in a minute, but that means that 211 people placed a call option for this expiration date and for this strike price. And volume is good. The more volume you see, the more chances there are for you to sell that contract. So you want to see volume. And this is the beauty of options because you only need a little bit of money. For example, this Fubo is $100. And that's the mystery that I was wondering for so many years is how much money do I need to get started with options? And we can see in the Fubo case, it's as little as $100. Some of them are as little as 10 cents if the stock price is lower. Let's continue. Okay, so we see that my one contract, which is worth 100 shares, is $98.52. But what if I wanted to increase that one contract to 2, 5, or 10 contracts? Because suppose I had $1,000 to invest. I would click change the order and I would increase my quantity to 10. And now it's asking me again to select limit order, and then it's asking me again to enter the price, which is what E-Trade does. E-Trade always makes you repeat the steps because they want to confuse you. So we would add 0.98, and now we see that it will cost $985.15, which is 10 contracts. Each contract is worth 100 shares, so that would be worth 1,000 shares. And like I said, I would never hold these 10 contracts on expiration date. I would sell them before or on expiration date because I don't want to have 1,000 shares of Fubo. I want to make my money and I want to get out. And then we would click all or none because you want all 10 of them to fill in that one order. If you don't click all or none, maybe 5 fill but 5 don't. And suppose you have 5 minutes left to the closing bell, and you really want these contracts. That's why all or none has an advantage. Then we click preview order and we see the estimated cost is $985.15 and the volume is 211. So if I wanted to place that order, I would click place order. It tells me your option order has been placed. Then I can go to view order because I'm obviously going to cancel it right now. And I see my order here, which is option buy to open. 10 means all or nothing. AON means all or nothing. That was the 10 that I chose, the 10 contracts. This is the expiration date, May 15th, 2026. It's the $4 call. It's a limit order because I'm limiting it to this price. And the status is open. So obviously I'm going to cancel that. Okay, so with the Fubo example, we learned about options chain, strike price, choosing an expiration date, and having a limit on the price you want to pay for the contract. Let's look at another stock price with a medium price, and then let's look at one with a higher price. This will give you an understanding of how much more you will have to pay for a higher priced stock. Okay, so in our second example, we're going to look at DraftKings, which is another one of my favorite stocks, and I placed a call option last week on it, and I'll show you that later in the video. And you can see that it's trading at $34.10. Fubo was trading at $3.40. So we would select a date. Let's select March 20th, and we see the strike prices in the middle. And now we see that instead of 82 cents, which was with Fubo, we see $4.89. And a very easy way to look at this and not get confused is to just get rid of the decimal point, because that decimal point really confused me in the beginning. So just look at it without the decimal point. So what do we see? We see $4.89 for the $35 strike price for March 20th, 2026. And because I think the stock is going up, I would choose a call, and I would choose the $35 strike price, the $37.50, the $40, or the $42.50. Okay, so let's choose the $35. Okay, so it takes us to this screen, and once again, our strategy is a call because we think the stock is going up. The action is buy open. It's a limit order because we want to select the limit price. And in this case, the last price was $4.89. The asking price is $4.85, and the bid is $4.30. And remember what I said, you're most likely going to get the asking price. So we will enter $4.85, and that's for one contract. And remember that it's times 100. So the total is $485 for one contract, which is worth 100 shares. And if we enter 2, that's worth 200 shares, and $4.85 times 200 equals $971. And we would click all or none because we want both of them to fill. Then we would click preview order, and we see the preview order here, which is for 2 contracts. AON means all or nothing because we want both contracts to fill. It's the DraftKings March 20th, 2026 $35 call. We're choosing 35 because we think it's going to go higher from where the price of the stock is currently at, which is $34.35. And our limit price is $4.85, which is the asking price. And we see a volume of 66. So that means 66 people on Friday placed the same order, or they sold some of their contracts. We don't know. We just know that 66 orders were placed on Friday, which was the last trading day before I made this video. And the higher the volume, the more advantage that you have. So that would be placing a call option order, and placing a put option order is the exact same thing. The only difference is we are investing that the stock will go lower than $34.10. So our first option for a put would be $32.50, which is priced at $3.45, which is times 100, which would be $345. Remember, just get rid of that decimal point, and that will cause less confusion. So suppose we click that strike price for March 20th, 2026, and we see that it's the exact same thing as a call option, but our strategy is now a put and not a call. You see that? So we click put, which is investing that the stock will go lower. Our action is buy open. If we were going to sell it, it would be sell to close. Sell open and buy close, I do not know what those are. I have never used those. It's either buy open to open an order, or to sell close to close an order. So in this case, it's buy open. It's a limit price because we do not want to pay more than the asking price. And the asking price in this case is $3.85. So $3.85 times 100 equals $385.52. for one contract that is worth 100 shares at the expiration date, which is March 20th, 2026. If we wanted 2, we would put 2 and click limit again and enter 385, and we see that it's $771.03. If you want 3, you enter 3. If you want 10, you enter 10, and so forth and so forth. Then we click all or none. We preview the put order, and it takes us to the preview order page, and we see that we have 2 put option contracts All or none means you want all of them to fill. The cost is $771. It's buy to open. It's a limit order. Our limit price is $3.85 times 2 times 100 equals $771. And here's an interesting thing. I see the volume is 346. And remember with the call option, it was 66. So this volume is higher. So the purpose of this segment was for you to see that DraftKings is trading at $34 and Fubo was trading at $3. And you can see that this one is $489 and Fubo was 82 cents. So the higher the stock price is, the more the option contract will be. So now let's look at our third example of a much higher price stock. So you can see the difference in the price for the option contract. And the point is for you to understand that the higher the stock price is, the higher the option contract is. And the purpose is that you may not be able to afford some option contracts, as I cannot afford some of them, or I don't want to risk that much money because an option contract can expire worthless. Okay, so our third example is Meta, which is trading at $700.16. So we would click the same expiration date, which is March 20th, and we see that the next strike price above 716 under the calls would be 720 strike price, and the price is 73.50 times 100, which is 7,350. Remember, just remove that decimal point and that will give you less confusion. So notice the difference here. 7,350 versus DraftKings was 385 and Fubo was 82 cents. And we see that the put would be 6,378. So the put is less than the call. That's probably because nobody thinks it is going lower. Okay, so now that you understand that the higher the stock price is, the more you're going to pay for the option contract. So now let's briefly go over the dates, because the earlier the date, the less price you will pay for the contract. The farther out the date, the more you will pay. So I'm going to briefly touch on this, but as you are trading, as you are placing orders, you're going to quickly figure this out within 3 to 4 trades. So now let's go to a closer date to where we are at in time. The first date is October 24th, because today's date is October 18th. So we go to October 24th and we see that the first call option above the trading price is $717.50, and the price for that call option is $1,223. So that's a major difference than the 7,000 which we just saw in March. So the purpose of this is to show you that the closer you are to expiration date, the less price you will pay for the option, whether it's a call or whether it's a put. Now let's go to the next date, which is October 31st. We see that it's a little bit more money, which is $3,170 for one. Then the next date is November 7th, and we see the first one that is available is $3,263, so it's a little bit higher. Then November 14th, it's $3,540, which is a little bit higher. Now let's go past March and see if it's more than the 7,000 in March. So let's go to January 15, 2027. And we see, wow, we see that this one is $12,900, which is a strike price of $720, which is the first strike price above the trading price. So that's an expensive option. And that's only one. If you had two, it would be about $24,000. And so forth and so forth. So as you're picking dates, you're going to realize that the farther you go out, the more money it will cost you, because we don't know what's going to happen with the stock. Anything can happen. And most likely, Meta will go up. That's why it's more money. Okay, so the next thing to consider are these three terms: in the money, at the money, and out of the money. So let's go back to our DraftKings example so I can explain this. Okay, so we're back to the DraftKings example, and you can see these blue lines here and these blue lines here. And then we see these white lines here and these white lines here. So what is the difference between these colors? The difference is that the blue lines are in the money. And for calls, that would mean that the stock price is either at $34 or above it. So we see the $30 price is in the money because DraftKings is at $34. So that's in the money. And the same thing with the 31, the 31.50, the 32, the 33, and the 34. As soon as DraftKings hits $35 a share, this will be blue, which means it is in the money. So if you are holding one of these contracts, you are now responsible for those 100 shares when the expiration date expires. And that's why I said be careful, because you may not want to hold those 100 shares. So you would want to get rid of it on expiration date or before. And when we look at the put side, we see that DraftKings is trading at $34.10. So the person that placed a $35 put is now in the money because DraftKings is lower than $35. DraftKings is at $34. All of these strike prices here are in the money because DraftKings is lower than all of these strike prices. So the blue lines are in the money. So what does at the money mean? At the money is the exact price that the stock is trading at. So in this case, DraftKings is trading at $34.10. So at the money is $34, which is right here. So if I buy this put or this call, I am buying at the money. And a slight move in the stock, whether it's up or down, will put me in the money very easily, very quickly. So if I have a call and DraftKings goes to 35, I'm already in the money. If it goes to 33, I'm then in the money on this side. And like I said, you're going to quickly understand this as you're trading. What is out of the money? Out of the money is any price that is away from your strike price. So in this example, let's choose 34 as our strike price. And let's say we have a put. Anything away from the strike price would be out of the money. So 33 is out of the money, 32 is out of the money, 31.50 is out of the money, 31 is out of the money, and 30 is out of the money. So 34 is in the money. Anything away, which is lower because you're placing a put, is out of the money. And it would be the same thing with the call. Let's say 34 is our strike price, which is in the money because it's exactly at 34. Anything above 34 is out of the money. So 35 is out of the money, 35.50 is out of the money, 36 is out of the money, so forth and so forth. And so 36 is out of the money right now, but let's say DraftKings jumps to 36 on the next trading day. All of a sudden, it's now in the money. And the last thing I will say about out of the money is that the farther you go out of the money, the less you're going to pay for the contract. So let's go back to our March 20th example. The farther out of the money, which is anything above 34.10 for a call, will be cheaper. So what do we see here? We see the $35 strike price is $489. As we go down, it's more out of the money. So when we get to $47.50, we see that it's $1.21, which is $121. So the farther you go out of the money, the less you're going to pay. And the farther you go out on expiration, the more you're going to pay. So just understand those two concepts briefly because you're going to learn that right away as you're trading. I don't want to confuse you for now. I just want to throw it out there. Okay, so now that you understand in the money, out of the money, and at the money, which is very simple, and you're going to understand it right away after a few trades, let's now look at my portfolio and see what options I have in the money as we speak. Okay, so let's take my SoundHound AI example. I have a $16 put, an $18 put, and a $20 put. So from these three, we see that this one is blue. That means it is in the money. So when this expires on January 16th, 2026, and if it's still blue, I will be liable for those shares. And like I said, I don't want to be liable. I will sell this. So you be careful careful not to be liable for the shares when something is in the money. So why is it in the money? Because SoundHound is currently trading under $20. That's why it's blue. When SoundHound trades under 18, this $18 one will be blue. When it trades under 16, the $16 one will be blue. But for now, this is the only one that's in the money. These are out of the money. It's very simple, so that's all I'm going to say for now because you're going to quickly understand it. And so these are all of my options that I have in my portfolio right now. And you can see that some of them are blue. All the blue ones are in the money, but a lot of them aren't. So I'm expecting a lot of these to turn blue because I have puts on all of these. I have a lot of puts right now. And you can see that I placed that DraftKings one here, which is at March 20th, 2026 expiration 35 strike, which is a call. So I'm expecting that one to go up. And I'm going to add to that one. And I will make videos on that in the coming days. Okay, so far we learned how to get to the option chain page, which shows us the prices. We then learned how to choose an expiration date. We then learned how to identify a strike price. We then learned in the money, out of the money, and at the money. And we then learned how to place the order for both calls and puts. So now the final thing I'm going to discuss with you that I think is important to say is how to allocate each trade according to your budget. So let's take a quick look at my portfolio and see how much I'm trading with and how to allocate the money into each trade. Because you want to divide it up equally. You never want to lose too many eggs in your basket. You want all the baskets to be separate, each one with the same amount of eggs. That's my strategy. You don't have to follow it, but be careful. Okay, so this is a snapshot of my portfolio, and you can see that the overall value is $34,487, and I currently have $11,514 in cash. And for the year, starting January 1st, 2025 to October 18th, 2025, I have made $26,268. And this is all from trading options. And keep in mind, I started with about $7,000. So I basically almost quadrupled my money with options. So the point I want to explain right now is that I have $11,500 in cash. That money must be divided equally. So I'll tell you exactly what I'm going to do with this $11,500. Okay, so with my $34,000 that I'm trading with right now, I personally will not put more than 7% on a trade, which comes out to about $2,300. And why is that? It's because 7 out of 10 trades will win, but 3 will lose. So if I lose $2,300 on one trade, I don't care because I'm going to make it up on another trade. And you never want to lose your shirt putting too much on a trade. There's no portfolio manager that has more than 10 to 15% on one stock. These are the rules of the books. So with my $11,500 in cash, I can place about 5 trades at around $2,100 each trade. And that's the discipline that I will have. And that's the discipline that you should have. So if you're trading with 100 grand, you figure it out. But it cannot be more than 10% a trade. And I would still say that that's high. Okay, so with all that said, and that's all I have to teach you, I'm going to show you a few of my winning trades, which has given me confidence that options is the only way to double and triple your money. And I hope this gives you motivation to watch my videos because I am very motivated to make the videos and to keep trading. And like I said, I want to get rid of my boss and I never want to have a boss ever again. So let's look at some of my winning trades. Okay, so let's look at my 4 Reddit trades that just happened over the last 3 months. The first one made 75% profit. I invested $2,170 and I made $1,578. The second one, I invested $3,000 and I made 65% profit, which is about $2,000. The third one, I invested $3,600 and I made 135% profit. Easy double. Then on the fourth one, look at this. I invested $2,950 and I made 225% profit. profit. All of this within 3 months. And it was an easy, no-brainer call. One of them was with a call, and 3 of them were puts. So as you can see, I am investing in stocks going up and stocks going down. In this case, I made more money with the puts. So in this example, in the SoFi example, I made 300%. I only invested $234 and I made $689. And all of this this one was in about 2 months. So as you can see, you only need a couple $100 to make big money. This was a 300% return. And to be honest with you, I sold this way too early. I should have kept it because this would have been a 700% return. But because I sold it too early, I only made 300%. But that's fine because I'll catch the next one. And now look at this one. I invested $265 in a HIMSS call and I made 500%. That is crazy. And this one took about 2 months. And trust me, I am trading HIMSS every single day I'm looking to buy puts or calls. So I'm going to keep you updated on my next trade in my next videos that are upcoming. And the last one I'm going to show you, but there are many more, but the video is getting too long, is this DraftKings call. I made 220%. I invested $641 and I made $1,400. That's a 220%. And I'm not done with DraftKings. I just showed you my recent call and I'm going to be trading this for many years to come. Okay, so there you have it, ladies and gentlemen. That ends the video, and there's a reason why the Nigerian brothers say it's not an option. It's not an option because you can make double the money in options than you can with shares. And you can invest going up and going down. And I am 100% confident that I'm gonna double my money with each trade. And of course, I'm going for 200, 300, and 400%. So I hope you look forward to watching my videos and seeing how I trade and seeing that my trades are educated guesses, because I'm going to show you income statements, balance sheets, cash flow statements. Each trade will have an educated reason why I'm placing the trade, just as all of these that I showed you were educated investments. So let me know what you think about the video. Let me know if I missed something. Make a comment. Share this video with your family and your friends. I hope you're on board because I'm reading every comment. And I know in 1 year, this channel will have 100,000 followers or more, because what I'm doing, nobody else is doing on YouTube. So get ready, ladies and gentlemen. Thank you for watching and see you in a few days in the next video.